Jesse, thank you so much for joining us today.
Yeah, thanks for having me. It's my pleasure to be here.
Definitely. And did you want to share with the viewers a little bit about your background if they haven't heard about you before?
Sure. Yeah, I right out of college, I went to work at Bear Stearns in Los Angeles, and actually got some people ask me, a lot of times how to get their start in finance, and so it's fun for me to kind of tell this story real briefly. I had some good advice from an alumnus when I was getting ready to graduate, and he said, find, somebody, an area where you want to be successful, somebody who's doing that and already successful, and go and just tell them you want to be like them, and you're willing to do anything it takes to make them more successful. And it was such a good pitch because it was kind of hard to get a job at the time. And I just went in, I found these guys, the most successful guys in the LA office of Bear, and that's basically what I said. But I also lived up to my promise, which was, do anything it takes to make their business more successful. And so I started out just running tickets at Bear Stearns, which, back in the day, a broker would write up a ticket, and then they'd need, take it over to the trading desk, and the traders would, put the order in. So I was basically just writing up tickets and running tickets all day for the first, few months I was there. I ended up finding a guy who was running a hedge fund inside Bear, and he kind of showed me, a lot of what I know today. We ended up leaving Bear and starting our own hedge fund down in LA, and I did that for a few years before I quit in early 2000 and moved here to Bend, Oregon, middle of nowhere. And I've been here for, 18 years. So, and just pretty much I started writing about the markets. In fact, today I was just looking at it is my 13th blogiversary, actually. I started my blog exactly 13 years ago today and been writing about the markets ever since. So.
Awesome. And getting started here, one of the markets we want to definitely discuss today is the gold market, and we want to get to some of the specific stocks you've talked about on your website. But first, if you wanted to give our viewers an overview on kind of your perspective on the current state of the gold market.
Well, I really started becoming more interested in gold back in 2015, and I'm kind of a traditional value investor, so I look for things that become really out of favor. And in 2015, gold became so out of favor, so hated that to me it became very, very interesting. That was when I think it was Jason Zweig, wrote in the Wall Street Journal, gold's really just a pet rock. And, so for me, I look for those types of sentiment signals. One of the questions I ask myself is, what's the most hated asset class in the world? And clearly gold was the most hated asset class at the time. It still is very hated, or at least there's a lot of, it's neglected right now to a great degree. And so that's when I really started becoming interested in it. And the more work I've done, the more people I've talked to over the last couple of years, the more bullish I've really gotten on it over the, and I think this is not a trade for me. This is a longer term, multi-year bull market that I think that's already begun, really.
When you look out at the broader market right now, Jesse, what is your overall feeling about what's going on, just in a bigger sense, I suppose?
Yeah, we're in the midst of another central bank fueled asset bubble, speculative mania. It's lowering interest rates to zero for the better part of a decade has created. Stan Druckenmiller wrote a great brief piece for the Wall Street Journal recently. He said, I shudder to think of the malinvestment that's happened as a product of these extreme Fed policies. And so, yeah, you lower interest rates to zero, people chase yield, and so it's the everything bubble. It's we had the dot-com mania, then we had a real estate bubble, and now it's stocks, bonds, real estate, collectibles. It's all kinds of stuff. And it's all centered around, quantitative easing and 0% interest rates. I think it's interesting now that those policies are starting to be walked back and unwound. And, if you believe that QE, quantitative easing, was bullish for risk assets, then you have to believe that quantitative tightening is potentially, it goes the other way against these things. So, yeah.
Well, cool. I did hear last week you did an interview with Simon Michalovich, who it was really interesting on gold. I was curious to hear what your thoughts were, because he he has an interesting take being from Russia. He probably has a little bit different viewpoint than most Westerners might. So I wondered what your thoughts were.
Yeah, he looks at it really as an insurance policy, and I was really grateful to talk to him. Simon's just a great guy and really smart when it comes to the topic of gold and precious metals. And he looks at it as, he was very intimately involved with the kind of on the cutting edge of the creation of CDOs and a lot of these financial products that led to the financial crisis. And a lot of these problems have only gotten bigger over the last 10 years. And so, for him, it's, how do I protect myself from potential problems in those areas arising again? And it's, for him, it's gold. For me, it's more than that. I think I do see it as an insurance policy, but I also see a lot of cyclical inflationary forces picking up right now. When you look at, it's not showing up in CPI, but look at the Fed's underlying inflation gauge, and it's 3.2%, which is, it has rarely been that high in the last 20 years. And you listen to what companies are saying on conference calls, and they're saying this is the most inflationary environment in 20 years at least.
Wow.
And so I think there's also secular forces. People point out the demographics. An aging population is deflationary. Well, the BIS came out with a paper recently that shows, no, it's just the opposite. An aging population is actually very inflationary because you don't have the working population to take care of those folks. And so you see, like wage pressures right now that we're seeing, which are cyclical to some extent, they're also secular because you just don't have enough teenagers to work all the fast food jobs that are out there, as the Wall Street Journal points out. You don't have enough nurses. I mean, you have baby boomer nurses retiring and a lot of older people going into hospitals and stuff, and you don't have a population that's going to come up and become nurses. So wages are going crazy right now, I think, and other cost pressures. And that's not just a cyclical trend. The BIS suggests this disinflationary trend as a direct result of the baby boomers is basically now morphing into a global inflationary trend that's, a 10, 20-year trend. And, so you think about real assets right now, especially precious metals, are, have never been cheaper relative to the prices of financial assets. And those go through big cycles. When do you want to own real assets? When do you want to own financial assets? The last 35 years, during disinflation, interest rates come down. It's been a great time to own financial assets. I think over the next maybe 10, 20 years, see rising inflation, and you're going to want to own real assets. And the, like Simon and I talked about recently, the most convenient and reliable way to do that is through precious metals.
Mm-hmm.
Now, it's not only physical gold that you think people should possibly look into investing in. It's also stocks, and you've talked about 4 specific stocks on your website. Can you explain about these stocks and why you think they will outperform gold?
Well, yeah, so I'm a stock guy, really, at heart, and that's where my expertise is, if I have any at all, is in analyzing stocks. And, to me, I see, the popularity of the FANG stocks has been just kind of through the roof in the last few years. And I've been writing over the last 6 months why, these stocks are facing greater risks to their business model. But that's another topic. I like the BANG stocks, which are the gold miners: Barrick Gold, Agnico Eagle, Newmont, and Goldcorp. They're essentially the 4 biggest in any gold mining gold miner index. And when you look at the FANG stocks, they're the highest valuation that they've traded at in their history as a group. When you look at the BANG stocks, these stocks are incredibly cheap. I mean, compared to their valuation history, they're actually cheaper today than they were in 2000, 2001, before the gold price took off and those stocks, went up 5-10-fold, a lot of them. And to me, that's really remarkable because their profitability is better today. Yeah, the gold price has fallen 40% or something since 2011, but they've been able to maintain their operating margins. And to me, the only criticism, the only justification I hear for this is, these companies have really been mismanaged in recent years, and they've just kind of blown up their balance sheets, taken on debt to make bad acquisitions. Yeah, that's all rearview mirror stuff. Mm-hmm. This bear market in gold has forced these companies to rationalize a lot of that and clean up their balance sheets and high grade their mines and all these kinds of things. And so they're much better positioned to take advantage of a rising gold price than they have been maybe any time in the last 20 years. And another statistic I look at is their 3-year average revenue growth. And so you can see the revenue went negative, back there in the late 90s, early 2000s, when the gold price just kind of languished. It went negative again after 2011, and in the last few years it's been negative. But now you look at the median revenue growth, 3-year revenue growth of these companies, it's all turning positive. And if you're bullish on the gold price over the next few years, these stocks have the ability to just go back to their median valuations, which has plenty of upside even without the gold price going up. But then if they really start growing revenues again, I mean, the stocks are going to be are essentially highly levered to the gold price, and they're really cheap right now, which is a great combination in my view.
I don't know if you ever looked back to the 70s versus the 80s play. It seems like when you do studies in the 70s and 80s for gold, it was bullion that kind of outperformed most miners in general up to about 1980, and then 80 onward, those mining plays really outperformed gold and bullion, obviously, as the bullion price was falling from 850 down to, I don't know what it went to, 400, then back up to 600. Those mining companies performed great in the first half of the 80s, it seemed like. So I wonder if we're going to see a repeat of that kind of situation where maybe bullion might perform well at first and the miners outperform it later, or if it'll be something. I mean, it's always a mix. It's never, right. So I totally agree. I was reading your Bang post, and it was really well written. Anyone should go to the Felder Report and read that Bang post.
Yeah, in terms of the outperformance versus underperformance, I think for me, as a value investor, Warren Buffett famously said, the price you pay determines your rate of return. And when these stocks become expensive, relative to the metal, then they're going to underperform, and they become cheap relative to the metal. Mm-hmm. And, today you look at the ratio of the gold miners, to the gold price. And, I also do a lot of technical analysis too, and mainly surrounding momentum. And you could see that, you look back, the last time the mining index was this cheap relative to the underlying metal was back in that early 2000s, time frame before the big bull market in those mining stocks. In fact, it's actually cheaper today, that ratio. So the stocks are very cheap relative to the metal also, which suggests to me that just a reversion in that relationship means the miners should probably outperform for a time.
Mm-hmm.
Now, moving our focus back to the economy, you've also recently reported about the flattening yield curve, and how do you think that will impact the economy and is impacting the economy right now?
Well, I think the flattening yield curve is, people say, well, it hasn't inverted yet. And it's going to be very difficult, I think, to see it inverted, especially if inflation is picking up. I don't know how you buy a 3% yielding, 10-year bond when the underlying inflation gauge is 3.2. And so, I think if we are seeing in a cyclical and secular upturn in inflation, I don't think the yield curve is going to invert. I mean, it would require the Fed becoming extremely aggressive. And I think the Fed realizes too much how important it is to protect asset prices. If they get too aggressive, they're going to burst this bubble that they consciously created. I mean, Ben Bernanke back in 2010 or 11 said, they're doing this on purpose. We're trying to create a wealth effect. And so they understand that if asset prices begin reverting as a product of them being too aggressive, that could have, that could really damage the economy. So, and they've said we're willing to let inflation run hot for a little while. So I don't see how we could get an inverted yield curve unless inflation just disappeared. And when you listen to company conference calls, that's just not happening. They're saying this is the most inflationary environment in 20 years, and it's only building in kind of pace of inflation, and they're only now beginning to start putting through price increases and all these kinds of things. So I think the curve's probably as close to inverted as it can get. And when you look at what corporate spreads do, the yield curve leads spreads, and so I think in that other post that I wrote, it's like 18 months or 2 years or something like that. You you get a narrowing in the yield curve, and then you start seeing a widening of corporate spreads, and so that's a pretty close relationship. So I'm expecting that these rising in interest rates are putting a pinch on corporate balance sheets. Corporations have taken on a ton of leverage during this cycle. Something like 50% of small cap companies have floating interest rate, mostly floating interest rate debt. So this has got to put a ton of pressure on these companies right now, not just cost pressure, but now pressure in terms on the debt side. So, those things suggest to me that we're probably going to see a widening of spreads and a change in risk appetites from risk on to risk assets to risk, maybe risk-free assets and other things that can protect people against inflation, like gold.
Mm-hmm. And switching back to risk-on assets, I know you've done a lot of research on FANG and social media and what's going on that front. I would be remiss if I did not ask. At least, in my obviously Facebook, you were well ahead of that story that hit the headlines, a few months ago. But you were talking about a year ago, I recall. Is there anything you're seeing on this front, and what are you seeing these days?
Yeah, I think it's really interesting. People underestimate the value of their own data, and they overestimate the value of the services that these companies are providing them. When you look at, okay, yes, we're getting free services from these companies, but they all have market caps in the hundreds of billions of dollars. That's what the data is worth. And the reason the data is worth so much is because these platforms have figured out how to manipulate people better than anything else in history, better than any propaganda technique. Advertising has demonstrated for a long time the power of, how do you spell relief? ROLAIDS, have a Coke and a smile. And these things just get ingrained in our brains from years and years ago. And that's powerful. But when you're not advertising to broad psychological parameters like that, now you can actually target people and manipulate them based on their unique triggers. This is what makes these platforms so powerful, but also so dangerous. And there's also the surveillance aspect of it too. I mean, Facebook and Google are collecting so much data. And I think this is really why the European regulators are out in front of this stuff more than anybody else, because they realize how powerful the manipulation techniques are, and they also realize the risks in allowing these companies to surveil their own citizens and then send the data back to the United States. Mm-hmm. And that's an issue that I don't think a lot of people are talking about. Is that Facebook and Google are collecting. I mean, they're going to know Europe's citizens better than European politicians, and View or any other platform you could potentially create, and that becomes a risk to your sovereignty at some point. And the European regulators have talked about this. They haven't made it the center point of their regulation, but it's absolutely the reason why they're going to be determined to neuter these companies in Europe. And I think other governments around the world are going to figure this out too. It's why China says, no, we don't want Facebook, right? Because we want control of the message that's sent to our citizens. We want 100% control. And so other countries are going to realize that this, has the power to undermine their democracy and put other nation states in control of what they would prefer to be in control of.
Do you see a potential in the future of other nations going the China route where they may nationalize some of the options for some of these services? Like, for instance, being they can just say, yeah, we'll have our own Google, screw it, Google, get out. I mean, could you see the backlash coming? I mean, that is pretty intense, I guess, the idea of that.
Yeah, no, I think that's probably right. The government wants to control all of this stuff. So this is one of the biggest risks to cryptocurrency and stuff too, is that, okay, you guys want to have a cryptocurrency, you want to have we're going to create a Federal Reserve version of it, and everything else is illegal, right? That's that's what is, if cryptocurrencies are going to work, that's how it's going to work, and because there's no way the Fed's going to give control of the currency to anybody else. But same thing with these platforms, right? If you want to be able to control what people see in terms of their news, how they think about it, how they feel about things, right? The government's not going to give that power. Once our government, I mean, you watch the Facebook, Zuckerberg testimony, and it was kind of silly. Politicians in the United States don't get it, right? But as politicians start figuring it out, they're going, oh my God, this guy's the most powerful person on the planet because he has this ability to manipulate people. Right now, he's auctioning it off to the highest bidder. But yeah, I do believe that countries are going to realize that the powers of these platforms are so beyond anything we've seen before. That if we're going to allow this in our country, we're going to be in control of it.
Yeah.
Now, what would you say to people investing currently in these stocks, Facebook, Amazon, Netflix, and Google?
I would just say that the one lesson of technology is that change, the only constant is change. And it's something about, I think Rob Arnott put out a piece recently, saying, yes, this is a bubble. And when you look at the top 10 companies by market value over 10-year periods, like 8 of them are not in the top 10 anymore at the end of 10 years. And just think about who were the top companies during the dot-com mania, and where are those companies today? Where's Sun Microsystems today? Where's Intel? Still 40%, 30% below its peak price from the dot-com mania. People don't realize that stuff. Now, when you pay an incredible price, you're pricing in perfection. When perfection doesn't materialize, you don't make money. And so I think the risks to these businesses are as great as ever. And they're only growing. People are pricing in perfection, and there's a big disconnect there.
Mm-hmm. Well, that's great. I want to thank you because I'm a fan of your podcast, and I appreciate you coming on. I also wanted to suggest that I don't know. I wanted to get maybe your feedback because you talked to William White last summer. That's one of the best podcasts and interviews I've ever heard. William White, for those that are not out there, if you could give him a background on who he is and just
he was the chief economist of the BIS. And he's been very critical of central bank policies, and he's just a brilliant person. So I was excited to talk to him too. But yeah, he's had some interesting things to say about. He was the one who first told me if quantitative easing was disinflationary, quantitative tightening is probably inflationary, and the Fed is really going to find themselves in a bind here, I think, with rising inflationary pressures, and then the fiscal authorities be getting aggressive with tax cuts and these types of things. The Fed's going to find themselves further behind the curve. They have to raise rates, but they can't raise rates too high, right? Because the government debt is so massive that we can't bankrupt the federal government in the process, right? I mean, They can't be bankrupted, but there becomes a point in time where if inflation's rising and the Fed has to raise rates, then people, potentially realize, okay, the government can't afford this. We have to print money to pay interest on our debt. And this is literally the potential perfect storm for gold that could happen down the road. And so it was interesting for me to hear a guy like Bill White, talking about this stuff, and he sees that as a real risk. So,
all right. Well, Jesse Felder, thank you so much for joining us today. Before I let you go, did you want to share with the viewers where they can find you and any last thoughts you had?
Sure. Yeah, I spend a lot of time on Twitter. It's my personal addiction. I just share kind of a lot of the reading and research that I'm doing. I share there.